Remember that in India, we now have 16 to 17 crore investors in the market. So imagine trying to find a marketplace where these 16, 17 crore people are trying to talk to each other and figuring out, okay, fine, are you interested in buying this, selling this? Who is interested? So it's just going to get completely out of control. And that is where a central marketplace or an ecosystem where the sellers can come, the buyers can come, everyone can just come to that one central place, the marketplace, and put in those orders. And then the job of that exchange, which is the marketplace, is to just make sure that you match the buyers and the sellers and find the clearing price. We all have seen this, it's a very colorful history of the stock market. One of the reasons why it's colorful is because you have a lot of con artists and scam artists and people who have really sort of used this to really make a fast buck and really leave the investors poorer. I think the most famous scam for all of us, especially people who've grown up in, probably in the 90s, is the Securities Scam. Probably was the most sort of disruptive event we have seen in the Indian stock market. Essentially, it was a very simple thing. What you're essentially doing is you're taking advantage of the fact that when we're talking about settlement cycles, there are securities which were effectively in limbo because A has sold them, but B has not yet received them. And in this intervening period, can somebody use these securities to actually profit from them and square off these things and give it back to B without B realizing that something has gone amiss? And that was the scam.
Hello and welcome to another exciting episode of Open Dialogue. The equity culture in India has taken root. Our market capitalization over the last 6 months has gone from $4 trillion to $5 trillion. A lot of retail investors are putting money into equities. However, the simple act of purchasing an equity or selling an equity is supported by a very complex ecosystem, which includes the exchange, brokers, settlement entities, and other market infrastructure entities. In today's episode, we will deep dive a little bit into how this entire ecosystem works and what brings forward to us the simple act of investing in a stock market. We'll also try to dive a little bit into the evolution of this ecosystem. Joining me to discuss this today is Ashwin Patni. Ashwin, welcome to the show.
Thanks.
Ashwin is the head of products and alternates at Access Mutual Fund. He has over 2 decades of experience in this space and he has expertise in product structuring, innovation and strategic initiatives. Ashwin, thank you for joining us.
Thanks.
So Ashwin, let's start with the bird's eye view of this entire space, right? When I buy, let's say, one stock or I sell one stock, what all happens between me getting it from another person or, the other way around? Which all entities are involved and what is the flow of this?
So it's actually behind the scenes, it's very, very, complex. And over the years, of course, technology has made it very, very seamless as well. So you don't really see too many of the entities that are involved because increasingly, for example, trading is done on the phone.
Right.
And you can just click a few buttons and whether you're buying something or selling something, off it goes. But the architecture is, as I said, reasonably complicated. And in India, I think we can be proud that it is probably at the most cutting edge technologically amongst any of the countries in the world in terms of the way we have put it together. Now, 3 or 4 big sort of type of entities that we should be aware of that are behind the scenes working to make sure that we can buy and sell or invest in and trade in equity markets. One is the market itself, right? So what we call the stock exchange, which is nothing but another word for a marketplace, which is where all of this activity happens. And to facilitate whatever is happening in this marketplace, you have a few service providers. Now, the chief of them is a clearing corporation, which helps clear the trades. We can talk about some of these things in more detail. There is a dematerialization or an entity that essentially ensures that the shares themselves are stored and transferred in an e-format. And then there are players like brokers, which are essentially people that work with the actual investors to put these trades on the marketplace and execute them. So quite a few pieces of the jigsaw. But the beautiful thing is that it is very seamless. You don't have to know all this to invest seamlessly. Today, I go back 20 years ago, we had this 3-in-1 account, I think, that one of the players did where you could open a bank and a custody demat and a broking account. And essentially that's what it takes for an investor to trade. Because if you have these 3 accounts and the 3 talk to each other seamlessly, then the few clicks that we are talking about works.
Right, great. So Ashwin, you covered many things. Let's go, let's say one by one and kind of explore each of these, right? So you spoke about the exchange. So let's say NSE or BSE, or there are many other exchanges, but these two main. You spoke about the clearing agency, you spoke about brokers, and you also spoke about all the other kind of people who, like the, let's say, NSDL, which holds your equities in demat depositories and so on and so forth. So let's start first with the exchange itself. So what's an exchange, and kind of why is an exchange required? Why can't just kind of people trade?
Yeah, it's interesting. You can, I can maybe give a couple of different examples to sort of contextualize this.
Sure.
Exchange, as I said, is just a marketplace.
Yeah.
Why do we need a marketplace? Now imagine you're a scenario like a power market. Now there are number of different power producers, and all of us are power consumers. And how does the power that gets produced come to me as a consumer? There has to be someone in the middle who's sort of laying the pipes. The pipes that take the power from wherever it is produced and bring it to me as a consumer. So that's the one way of looking at an exchange, because they are acting as a pipe who's getting people who want to sell and getting those securities into the people who want to buy. The other and probably the more accurate way is a marketplace. Think of an Amazon or a Flipkart. Now I have a phone to sell, or I have a purse to sell, or maybe I am a small businessman and I've made some furniture, and you are a consumer who's looking to buy that. And we can both go on Amazon. I can list my goods, and you can, as a consumer, go to Amazon or a Flipkart and go and sort of try to buy that. And essentially that's the function of a marketplace, which is that if we try to do this on our own, it's very, very inefficient. You have to go looking for the buyer. If I, as a seller, for me to go looking for buyers. And remember that in India, we now have 16 to 17 crore investors in the market. So imagine trying to find a marketplace where these 16, 17 crore people are trying to talk to each other and figuring out, okay, fine, are you interested in buying this, selling this? Who is interested? So it's just going to get completely out of control. And that is where a central marketplace or an ecosystem where the sellers can come, the buyers can come, everyone can just come to that one central place, the marketplace, and put in those orders. And then the job of that exchange, which is the marketplace, is to just make sure that you match the buyers and the sellers and find the clearing price and execute them. So it's almost like a it's almost like an infrastructure. It's almost like a bare essential. You do need it. We've had exchanges forever. BSE is the oldest exchange in Asia, almost 150 years old. And the reason why they've been around forever is that the need is been around. The minute trading becomes even a slightly more complicated, in terms of number of people or number of securities being traded, you quickly realize that you need a marketplace, a common area where in the old days it was a physical marketplace. Everyone had to come to a physical area. These days, of course, everything is online and digital. But you still need one place where everyone can just assemble and do this to make it efficient.
Sure. So if you think of this transaction, let's say I am buying something that you are selling. Somebody you as an example, will come and put on the exchange saying that I want to sell stock X at price Y. And I will come there and say I want to buy stock X at price Y. The exchange will match the two of us. But I think then someone has to do the activity of physically, digitally transferring that stock of X from you to me. And also at the same time transferring the amount, let's say 100 rupees from me to you. So the exchange plays this role also, I presume, which is kind of...
Exchange it just provides the infra for people to do this. But there are different entities who do it.
Right.
I think one of the most important and sort of behind the scenes that most people don't really think much about is the clearing houses, they're clearing corporations.
Right.
Now they play a crucial role.
Right.
Let me again explain it try to explain it in a simpler sense, that suppose you want to buy and I want to sell. And if we were to do it in a normal life, you have a counterparty risk on me.
Right.
Because I can take your shares and not pay you the money.
Exactly.
Or I can pay you the money and you can refuse to transfer the shares to me.
Yeah.
And this was a very real issue that used to plague stock trading or any kind of marketplace for many number of years.
Right.
And ultimately this was resolved by figuring out that you need to have somebody sitting in the middle that will ensure that every trade goes through.
Right.
And that is nothing but the clearing corporations. Right. What they do is they become the counterparty.
Right.
So today, for example, when you go to a BSE, NSE or any of the exchanges and try and do a buying and selling, it doesn't matter who. So suppose I put a trade for a buy order of 100 shares in X. I will never know who sold it to me.
Right.
And I don't need to know.
Yep.
Because actually the entity that I am buying from is the clearing corporation.
Right.
If I'm selling, I will never know who bought it from me because the matching in the middle is being done by the clearing corporation. So they are ensuring that all trades are going through, whether it is in terms of transferring the money in one direction or transferring the securities in the other direction. And they will ensure that these trades go through. And they therefore are the most important piece of plumbing that is required to run this marketplace. Then there are some other players whose job is to actually carry out some of the operational aspects, like the actual holders of the securities, which is what the depositories are, or the brokers who sort of put the trades onto the platform, etc. But clearing corporation is where this matching of trades and making sure that it goes through happens.
Right. And the clearing corporations are who? Like, which are the big ones?
So NSECL, all the exchanges have their own corporations.
There is
NSECL, and the good thing is that the Clearing Corporation of India. So there are 2 or 3 players who are relevant. The good thing is that for most investors, it doesn't.
It doesn't matter.
Because
but there are 2-3 of these.
Yes. Because there are these big ones, they are backed. They're regulatorily sort of controlled. They are seen as market infrastructure players. So they are not really trying to make money from this activity. Their job is to really risk manage the whole thing.
Right.
So what they do is they really ensure that if they need to take some money in advance, or if they need to take margin, or they need to take some collateral, but whatever they need to do to ensure that this happens smoothly is their job.
Right. So we'll come to that point now. There is this clearing corporation sitting in between. I am buying, you are selling. The clearing corporation needs to know that you have the stock.
Yes.
Because otherwise, how can you sell, right?
Yes.
Like, otherwise you can just come and say, I want to sell, but then you don't have it at the end of
Correct.
the day. Similarly, it needs to ensure that I have the money.
Correct.
So how does the clearing corporation do this?
So there are protocols that have been set up.
Right.
And those protocols ensure that everything works.
Right.
So for example, and most people would have, who actually trade would have seen this, that today when you put in a sell order, that's an easier one to explain, your broker does the check of whether there is share that is there or not there. Suppose you're looking to sell shares in company X, and you're trying to sell 100 shares. So before you are allowed to put that trade in, the broker will ensure that 100 rupees is locked up.
Right.
And it is not available for putting another trade, or it is not available for you to do any other transaction.
Right.
Why is the broker doing it? Well, the broker is fronting it. The broker is back-to-back doing this because back-to-back this is what they need to square off at the exchange level, where
Right.
all clearing members have to get together and make sure that any order that is coming through, so the broker does that at all the trades that go through at their level, and different players do it like that. And their job essentially is to follow the protocol that is laid to them, and to ensure that for the clearing of these trades, there is no risk that is created. How is this done in practical terms that no risk is created? As I gave you the example of a sell order, the shares are clearly locked up, which means that they cannot be touched by anyone. You cannot put 2 sell orders by mistake on the same set of shares. If you're putting a buy order, the money gets locked up, so you cannot use this money for something else separately while the order is being executed. And there is a certain element of what we call margin money that is also in the system, that is provided for making sure that trades go through, or if there is, for example, things like F&O, etc., which may not involve actual securities, but therefore for them there is that margin can be used to ensure that the trade goes through. So I think a lot of it is just the protocols that have been set up, that things need to be done in a sequence. You need to make sure that A, B, C is there, and only then the trade is put on the exchange. And that sequence really is what ensures that we don't have these failures in terms of bad delivery or trades not going through or anything.
Right. So just to simplify this, there is a clearing corporation. The clearing corporation is talking to the brokers, and there is the buyer's broker and the seller's broker. The seller's broker basically confirms to the clearing corporation that, the aggregate of their clients, let's say they have 100 clients and they've placed various buy, sell orders, etc. But the aggregate of the buy orders or the sell orders that they've placed, they have that many equities on the other end.
Yes.
And we'll come to how the broker is doing that in the next this thing. But basically somehow the broker is saying that total my clients have placed sell orders of, let's say, 10,000 shares of Infosys. So those shares exist. Similarly, the buy side guy is saying, okay, my guys want to buy this, and hence, let's say the amount is 1 lakh rupees. They have 1 lakh rupees somewhere, and I have blocked that 1 lakh rupees. Yes. And then the CCI, whichever is the clearing corporation, will match the 2 trades, and hence there is no risk. At the end of the day, if you bought Infosys, you will get it, or if you sold Infosys, you will get the money.
Absolutely. And therefore, that is why these are all regulated businesses.
Right.
Because there needs to be a certain protocol in place.
Yep.
You cannot have a cavalier or a cowboyish approach saying that, I will allow you to trade without anything, or I will let you do something without having the proper checks and balances. And there is a reason why regulations exist, and that is to instantly ensure that this whole mechanism keeps working smoothly without disrupting any of the players. Essentially, what those regulations ensure is that every player plays that role
Right.
that is expected of them, without which the trade would actually not go through.
Right. Now let's come to the brokers. What role do the brokers play in this?
I think brokers are client facing. So their main job, they have two roles. One is their main job is the client facing part,
Right.
which is that they work with clients to essentially provide the platform. So most of us don't actually see the exchange platform,
Yep.
right? Because what we see is the broker platform.
Yeah.
Now, the broker platform obviously talks to the exchange platform. And so, if you are trading on the phone, or if you're using your computer, where you will put in your order will be the broker's platform, and say ABCD broker. And essentially, therefore, the broker's role is to ensure that you have the systems that can actually support all this. So they will be able to put in these orders, the clients can access their holdings, the clients can put in these orders. And whatever, from a technology perspective, once these orders are there, they can then be routed to the exchange in a seamless manner, and then exchange can then, they can get executed on the exchange, as we've already discussed before. So the role of the broker is essentially to work with clients. So therefore, client account opening, doing whatever they need to be doing in terms of getting the architecture in place, having their bank account, demat account, other accounts that they need to have, to ensure that they can trade seamlessly. Also giving clients education about trading. So their role is also to talk about, what are the trading ideas, what could be there in the market, talking about the market, giving views on individual stocks and markets. So brokers do all of this. And ultimately, their role is execution. So they do all of this to facilitate the core activity, which is allowing investors to buy and sell on the exchange, and which is what ultimately gets evidenced in the form of the actual technology of punching in the trade, which then talks to the exchange and takes it forward.
Right. So the broker A ensures that the client exists. I'm now talking from a risk management perspective.
Yes, and that's why you have what you call KYC, you can know your customer. So you have to, of course, everyone can open an account, but nobody can open an account without having certain documents in place. Again, it goes back to the regulations, that why do we need them? Because that will ensure that the system can work smoothly.
Yeah. So A, they ensure that the client exists and the client is legitimate. It is not some, a money laundering or anything of that nature. B, they will create the access for the client to talk to the exchange through the platform. C, they will do all this education, information provision, etc., etc. And D, they will help in executing the trade, which is they will, let's say you want to buy, they will put that on the exchange. They'll also work with the clearing house to make the fund transfer, etc. happen. Now broker is obviously a very important entity, right? How is the risk management of the broker itself done? Like, how do we know that if the broker has placed, let's say, 1 lakh rupees worth of buy orders, that he's able to, honor those orders?
So again, I think that's where the regulator, in this case, we haven't spoken about the regulator much, but SEBI, the Securities and Exchange Board of India, is the regulator for this entire sort of ecosystem. And I think they have done an excellent job in terms of clearly laying out the role of a broker.
Right.
In the past, and we all have seen this, it's a very colorful history of the stock market. One of the reasons why it's colorful is because you have a lot of con artists and scam artists and people who have really sort of used this to really make a fast buck and really leave the investors poorer. Some of the recent ones, of course, we know, but historically over the years, there's been a series of them. And there is a reason why the architecture has evolved like this, is to essentially, all of this have also acted as learning curves for all of us, the regulator chiefly, but also the rest of the ecosystem, on what is to be done. So I think one of the example I can give is that in the previous crisis, maybe in early 2000s, brokers used to take different investors' money, but also, it was called fungible, but it could also sort of mix it up with their own trading, mix it up with any other activity that they were doing. And all of it used to go in a very sort of fuzzy way to the exchange.
Right.
Now that is an issue, right? Because if something happens to the broker, then there's a lot of onus on the broker to segregate out these things and make sure that they are getting done properly. And B, if something happens to the broker, then what happens? It creates a big mess. And we have seen, I think, in the financial crisis and before, the big issue where some of the brokers, it's globally I'm talking about, but some of the learnings are there, where we saw, some of the brokers which sort of failed and created a huge issue in terms of payments, etc. So I think today the ecosystem is very clean because each of the trades go in pretty distinct manner. So the broker's job is essentially to make sure that the systems are up and running. When you talk about risk management, I think the main risk management is technologically.
Right.
Just make sure that the systems are up and running. There's no downtime. The trades, there is no latency in the trades, because what you don't want is when you put in a trade today at say 9:30 or 10 o'clock, and then for some reason there was a bug in the system and then the trade only goes at 10:30 or 11, because market is dynamic, price can change, situation can change, the investors trying to buy and sell with a certain context. So it needs to be completely seamless. So
Right.
the main risk is technology today. In the past, of course, there were other risks,
Right.
but I think a lot of those things from a systems perspective have gotten resolved.
Right. Let's say a broker goes, hypothetically, broker goes bankrupt, and obviously the kind of trades are always ongoing, right? What happens?
So it won't be completely sort of. So the good thing is that, like I said, over time things will get resolved. It's not that. First of all, the chances of that happening are becoming more and more remote because the brokers are sort of isolated in terms of the kind of things that they can do, and again, regulations play a part there. But also, assuming this happens, and you can never say never, right? You can always have a scenario. So I think untangling it will not be that complex an exercise as it would have been, say, 15 years ago or 20 years ago.
Right.
And today, the good news is that the rest of the ecosystem is going to be around and they will be able to untangle these things. So your money is in the, say, the bank, or your shares are with the demat account, etc. So the role of the broker essentially only to facilitate the transfer if the trade goes through.
Right.
And if the trade has not gone through, it's not gone through. So it's maybe it can be a little fuzzy and messy for maybe a few days, but I don't foresee today the situation to be as challenging as, like I said, in the old days where we genuinely had a situation where when brokers went bankrupt, then you could take months and months to figure out, and you could actually have a situation where people lost money for no fault of their own, but just because their brokers took on risks which they didn't realize.
Right.
I think today you don't really have that kind of a risk.
Right. And I guess the broker also keeps some margin money with the clearing house so that, the trades can be done. And I guess their exposure will be limited to the amount of margin that they have.
Absolutely. So these are all safeguards that have now been built in to ensure that each party's trading, the each party's sort of capacity to trade is in line with the kind of margins they've placed, the kind of systems that they have, to ensure that people don't suddenly sort of go out of, either from a technology perspective or margin money perspective, go out of their league in terms of suddenly doing something very different from what they're capacitized to do.
Yeah. My next question, which is, let's say I'm trading and I'm trading, let's say, in FNO. Now I have bought or sold something. As the market moves, my exposure also changes, right? And as an example, the broker will many times call on me to put more margin money.
Yeah.
And if I don't put margin money, they will self-liquidate the position and, kind of reduce the risk. So what's happening here, and why does all of this happen?
Yeah, so I think margin is a way of ensuring. So margin is what? Margin is essentially some amount of cash, very simply speaking, that you are setting aside as a safeguard to ensure that if your trade has any issues or if there are any challenges, then this cash can be used to make good any deficit or anything like that.
Right.
So that's a margin is a very simplistic concept. It's been around in many other places. You have a margin even in businesses. You put some margin if you're trying to take some, for example, an LC or something.
Yep. Or an advance payment.
Or an advance payment. So the risk aspect of margin is well understood, right? It's just a safety money that you set aside to take care of all eventualities in case there are certain eventualities that don't play out. Now, in cases of cash equity, margins role gets more limited.
Right.
Because there is an actual share that gets traded. So you could have a temporary margin while the trade actually goes through. So while the settlement goes through, because we are not instant settlement. The settlement can come. So the delivery of the share comes one day later, or the money may go at a certain time. So in the sort of interim, you could have a situation where a margin can help sort of navigate that. But in an F&O, the situation is very different, right? So derivatives, for those who don't understand, is essentially a derivative of a cash equity. So either of an index or a stock. Derivatives themselves are only, as the name suggests, a derivation of something. So they themselves don't mean anything. They are only a contract which is a derivation of the core. So through a simple example, if we say what is a future on a cash equity is a future right to buy or sell, or ability to buy or sell that stock at a future date. So it's just a derivative of the cash thing. So why is this important? Is because therefore there is no actual ownership that is transferring. It's just a position that can get created. You can take a short position, I can take a long position. Short position meaning you are intending to sell, long means I intend to buy. So we could get into a position like that. And the difference is that these positions can get created independent of the number of shares. So if a company has 1,000 shares in existence, every trade we do will need to refer to these 1,000 shares. We can only trade these 1,000 shares. We cannot suddenly trade 10,000 shares. But derivatives are very weird because you can actually create a buy-sell right, a different long-short right, different from these 10,000. So which is a little complex maybe for another day, but that's an important thing to keep in mind, and that is why margin is very important when it comes to F&O trades,
Right.
because you need to have margin to be able to put in a trade, but also you need margin to be able to maintain that position on an ongoing basis. As you rightly said, the other important thing about F&O is that you don't pay the whole consideration, you only pay certain margin that is needed. And that is why one of the reasons why F&O trading gets popular is because essentially it can be used to take a leveraged position, because you only require to pay the margin. Suppose the margin is 20%, so you can take an effectively an exposure which is much higher, rupee for rupee, compared to what you would have had to take when you're just buying or selling the actual cash equity. So that is where margin becomes important, and that's where margin management becomes important, because it's an ongoing thing. You've only taken the margin for setting that position, and therefore, how do you make sure that if the prices, as you said, rises, falls, depending on which side of the trade you are on, make sure that you keep taking up that additional margin to safeguard the trade at all times.
So it's a way of, again, kind of, if I have taken a position and you've taken the counter position and my position is running into losses, it's a way to ensure that at the end of the day, actually you can be made good, because otherwise I can take infinite risk and you may be left hanging at the end of the day.
Yes, the basic principle remains the same, that how do we ensure that both the counterparties are safeguarded in the eventuality that any one of them is not able to pony up or is not able to honor what they've gotten into. And that is where you make sure that you keep putting in the margin, keep topping up that margin, and that ensures that the whole system works.
Understood. And this, I guess, like the margin is being deducted by the broker. I presume at the back end, he has to place with the...
It's a back-to-back. Whatever the broker... So the broker can always play safe and do something additional over and above.
Sure.
But there are base levels that the exchange puts in, the norms that exchange puts in place. And some of it could even be regulatory in nature, where the regulator gets into the picture and says that in certain cases you do need to take certain additional margin, just in the interest of safeguarding the whole system.
Sure. So that's how the entire system gets safeguarded, because if there is a loss, then the client's loss is taken by the broker to the margining, and the broker level aggregate, whatever it is the broker has to place with the...
Exactly. So if the margin system works smoothly, then there is no question of any loss or default going to any wrong party, because each person who's taken a position either has actual cash behind them or enough margin to be able to square off that position. And to make sure that you can get them or throw them out of the position if you need to. So if that's how that whole system is supposed to work, that if it works smoothly, there should be no bad trades or no default trades.
Right. We'll move to another component of the ecosystem, which is the depository. So what's a depository and what role do they play?
So depository is simple. Old days, many of people who were investing in share market 30, 50 years ago would remember there was a physical share certificate. Each share had literally been, and many of you know today, if you live in a housing society, then maybe you've seen the share certificate of that society. So it is an incredibly messy system, because certificates can get torn, they can get lost, they can get faked. It doesn't make sense to rely on a physical paper if you can avoid it. In the old days, there was no choice. Technology was not, there was no technology solution available, but the solution, once it became available, was very easy, because you could move this to what is called a dematerialized format, which essentially means that instead of relying on physical share certificates, these share certificates could be created digitally. And when you talk about that, then there needs to be somebody who does that role. And depositories are essentially entities that create these digital footprints or these digital certificates, shared certificates, and manage them, so to speak, which means how many are in existence, who do they belong to, moving them from A to B when trades happen, transferring them, all that role. So who plays that role? And it works in conjunction with the exchange, because when the trades happen is when they move, but where they lie is where the depositories are. So depositories need to be able to talk to the exchange, because to give that information of who owns what at any point in time. And when the trades happen, the exchange needs to talk back to the depository, because when the trade has happened, then where does it need to move now from whoever used to have it before to now where it needs to go to.
Yeah. So if you think of it, it's a very complex system, right? Firstly, there is a demat account. So as an investor, I have a demat account. All my securities are lying in that demat account.
Yes.
Now, this is not a physical account, but it's a digital account, but it's all lying in that demat account. I can choose to assign any broker, like I can choose any broker, but then they will all finally go and, talk to this demat account. And then I have a broking account, which is my account with the broker. And then I have my bank account, which is where my money lies. And these three have to seamlessly talk to each other, because when I tell the broker that go and sell a particular share, then that broker will have to go to this demat account and, kind of whatever.
Yeah, but I think it sounds complicated, but just, a bank is also a depository.
Yeah.
In the old days, everything was a note.
Yeah.
So if I had to buy something, I have to give you that note and buy the good.
Yeah.
Today, most of the money is electronic.
Yeah.
When we have money lying in our bank account and we transfer something, or say UPI something from one account to another account, that is nothing but a demat transaction, because the money is essentially got dematerialized. That money is lying in digital form in your account, and you have chosen to transfer it to another account. So share trading is happening in exactly the same way. Your shares are lying in a particular demat account, and when you are just linking it up in such a way, just like how we are linking bank accounts in a UPI, transaction, you're linking those demat accounts through an exchange. UPI is simple because it's one-to-one.
Yep.
The minute it's many-to-many, because many people are selling, many people are buying, and that's where marketplace comes in the picture, and that's where an exchange comes, and that's where you need something like a depository to make sure that it doesn't become a mess and it smoothly goes from the right person to the right person.
Sure, understood. Great, very insightful, and thanks for covering that. Now I have one final question before we move on to some other topics, which is when I buy or sell an equity, let's say if I sell, it takes a day for the money to come, or sometimes even longer, typically a day. Similarly, when I buy, it takes a day for the stock to show in my account. So what's happening here, and why does it take that time? And if I understand right, at some point in time, this used to be a week, and then we moved to T+2, and now we're at T+1.
Yeah.
SEBI is talking of T+0 as well. So
So this is what is called the settlement cycle. So the trades have to get settled.
Right.
So what typically happens is that you have the market which is going on, and it's not instantly settling every trade. What is this meaning of settlement of trade? Just to be clear, is that when I have initiated a trade, I want to buy 100 shares, you have initiated a trade, you want to sell 100 shares. The settlement, ultimate settlement, is when I am trying to buy, so I've received the shares, the money has gone, and you've received the consideration, and so that is the final settlement. Now, before the settlement, the trade could still go through on the exchange, but it is held in a sort of a, let's say, in fuzzy ethers, let's say, somewhere. It doesn't matter where it is, but it's lying somewhere, but it's not gotten final settled.
Yeah.
Because it's a safety mechanism. It's making sure that all the trades get reviewed properly, all the processes that need to happen for the correct settlement of these trades are happening in a certain way. Now, some of these processes are block processes. They are not live processes from technological perspective or system perspective, because it's just a level of complexity issue.
Yep.
You make it live, the complexity required is very, very different from doing a block processing where you wait for everything. And why do exchanges shut? Right? We have a trading day. Stock exchanges, other exchanges do trade all 24/7, but stock exchanges don't trade 24/7. So you have an opening, you trade during the day, let's say 9:15 it starts, depending on what you're trying to trade, and 3:30 it shuts, and then it shuts. Why does it shut? Because you're trying to take that block of trades and settle them at the end of day. So it is a batch processing, if I can call that approach that we are following here. It's not a continuous processing approach that we are following here. And that is why, because you are trying to make sure that the whole set of trades go through smoothly, all the margins are settled, all the other parts are settled. There are all the different facets of the trade, which all have to be make sure that they all work. And that's where you take that time at the close of transaction to make sure that all those things have gone through. And that's why typically it takes time for the trades to come in. Now, as we have gotten better at it, this time has shrunk. It used to be T+7, it used to be T+5, T+4, T+3. We've kept bringing it closer just to reflect the fact that we have gotten better at it. In the old days, physical share certificate, you could take months to get the actual certificate into your name. In fact, we can talk about that. There were scams where people didn't get them at all. And from there, when you dematerialized it, you solved one problem. But then there were other technological challenges in terms of making sure that the settlements get done in a certain way. So I think as we've gotten better at it, we've kept getting it finer and finer and finer. we've got to a stage where I think T+1 for most retail investors is not a big issue, right? It's like we go to Amazon, we buy a bag, we get it the next day or we get it 5 days later. I mean, it's got to a stage where we invest our money, we're buying shares. Is it a big disruption for us that we get it 1 day later or something? Not really. I think the only people who really worry about this are the very, very active traders who are trying to buy, sell, everything. But even for those people, there are sort of intraday options which are available. When I say options, intraday choices available of doing things intraday. So I think for most people, this system works reasonably well. Except, of course, the fact that if you're trying to sell and get money, then you have to plan it a little bit because you may have a certain amount of shares in your Demat account, but it is not instantly going to convert into cash today. You will have to go and sell it and the money will come to you. So I think that's where a little bit of planning perhaps may be needed. As you said rightly, there is a lot of discussion around can we move to T+0. It's not something globally that is a very done thing. I think what we are doing in India, as I said at the beginning of my piece, is already at a level which is technologically quite close to some of the best practices globally. So I'm not going to say that this is something that will happen very quickly. It will probably take some time, but I think technologically we'll get there at some stage of making it more sort of seamless.
Understood. So we'll move to the final section of this, which is will be helpful to understand maybe 1 or 2 instances that have happened in the past, which have caused some hiccups and what we've learned from them.
I think the most famous scam for all of us, especially people who've grown up in, probably in the 90s, is the Securities Scam. Probably was the most sort of disruptive event we have seen in the Indian stock markets. I think definitely before that, but even subsequently also, I think just the sheer scale at which it happened. And essentially, it was a very simple thing, at its heart. What you're essentially doing is you're taking advantage of the fact that when we're talking about settlement cycles, there are securities which were effectively in limbo because A has sold them, but B has not yet received them. And in this intervening period, can somebody use these securities to actually profit from them and square off these things and give it back to B without B realizing that something has gone amiss? And that was the scam, very, very simplistically put, of course, where there were trades where securities were being traded and in the pre-settlement, these securities were taken and used to take leverage and use that to actually prop up the certain stocks in the market, which were being sort of bought using the money that was coming out of these securities, which were actually not equities at all. They were securities which were on the bond market side. But because you could take advantage of the differences in the settlement cycle, you were able to sort of siphon money in that sense from that trade and use that to put that money into the stock market and really use that to prop up certain shares and sort of take their prices high. I think 2-3 learnings. One is, of course, we've tightened screws everywhere in terms of making sure that there is a clear settlement mechanism now and people can't profit from something which is pending settlement. 2, there is a clear sort of, I think the frenzy around buying and selling shares, etc., and being able to go and make loose statements around what is happening in the market. So just much more careful framework around what can be said, how can you portray certain things, much more careful monitoring of, for example, circuit filters, etc., of how prices go up and down and not make it disruptive. People cannot corner the market, much more careful monitoring around how these positions are traded, etc. So lots of learnings from that. Of course, it was a long time ago and I think the markets have really moved on since then. But I think really for many of the people in the markets today, I think a lot of their initial disruption or their initial learning or the reforms that we've seen in the market came out of that scam and came out of realizing what it was wrong and the plumbing which needed to be fixed.
Understood. Any other similar instance that you can think of that will be interesting?
I think the other sort of challenge we've had, I think again, which I think SEBI's done a fantastic work, is just corporate frauds. When you're buying and selling shares, then, one of the things that you don't want to do is getting, in the old days, you had it in the IPOs where people used to sort of, the prospectus, the data, etc., was not of the highest order of integrity. We've had companies, the biggest example probably Satyam, where they've not sort of been clear about their books. They've sort of fabricated data. And people have invested on the basis of data which came out clearly was sort of false data or fabricated data and obviously lost money. So as investors, one of the biggest things is that the improvement that has happened is just quality of governance and reporting and disclosures have become very, very strong. And you can you have faith when you see a number when you're trying to trade a stock A and you're trying to do research and say that stock A that I'm trying to buy has, as a company that has said that I make 100 crores in profits, can you rely on that number or not? And I think that has been the massive change that the regulator has brought in, where today there is a very, very high level of trust as investors that we can place on making sure that whatever numbers are getting reported by these listed companies, and when we are looking at these numbers to try and take decisions on buying, selling stocks, then we can really rely on them.
Fantastic. Ashwin, thanks a lot for sharing time with us. We covered a wide range of topics. We tried to peel the onion a little bit on, a simple activity like buying or selling an equity has many layers of complexities behind it and many entities, many large established entities which enable that trade. So we spoke about exchanges wherein the trades are actually matched. We spoke about the clearing entities which actually risk manage this entire thing and ensure that if somebody is selling, then that person actually has the stock to sell, and somebody is buying, that person actually has the money to buy.
Correct.
And neither of them at the end of the day are shortchanged. We spoke about brokers who play a very important client-facing role. They ensure that clients are genuine. They ensure that they are doing all the margining and following all the protocols so that the risk is again maintained. We spoke about the depositories who play the important role of holding dematerialized shares and doing all the transactions, moving it from one another account to another account. And so net kind of a very complicated ecosystem that comes together to ensure that risk is managed and folks like you and I can trust this entire market and not be, even the smallest retail shareholder can trust fully that he or she will not be shortchanged by some shark at the other end. We also covered some of the hiccups, things that have happened that have gone wrong, from which we've learned and has brought us here today. So great. Thanks a lot for sharing your perspectives. It was a great conversation. I really enjoyed it.
Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.